We'll debate the road ahead for the markets and what today's inflation read could mean for the Fed with the investment committee. Joining me for the hour, Jim Lebenthal, Liz Young, Joe Terranova, and Rob Sechin. But first, let's take a check of the markets very quickly. As we mentioned, the Nasdaq and the S&P hitting 52-week highs. The Nasdaq doing the best, up almost 0.75%. The S&P up over 0.5%. The Dow up almost 0.5%. But the big story here, the yield on the 10-year and actually all treasuries right now, we're seeing 3.85. Remember, just last week we hit a high of 4.09, so a big move to the downside when it comes to yields. And I think that's really where we should start this conversation. This move to the downside of yields, this inflation read, how does it make you feel about the markets and the possibility of a second half rally?
It makes me feel good. This is obviously part of my thesis, as longtime viewers know, is that I've been saying that inflation has been coming down faster than expectations, and basically that the Fed's work is done. Now, they are likely to go again in July, another 25 basis points. Public service announcement here. The Fed person, or excuse me, the insider, if you will, from the journalistic community is Nick Timiraos at the Wall Street Journal. He's the one that the Fed speaks to if they want to change course. So for the next couple of weeks, we just got to follow what Nick Timiraos is reading in the Wall Street Journal. I don't particularly like bringing up a competing journalistic outlook on a CNBC show, but he's the one guy. If the Fed is going to change, they're going to let him know. But regardless of whether they do another or not, it seems likely that that's it, that's done. What that means for the markets is that the lows, the risk that we go back to the lows of October of last year seem to be very remote. I think they are vanishing. At the same time, let's respect, Frank, the fact that the stock market's up 17%. And let's leave aside the narrowness of the rally for a second. 17% in a little over 6 months is a lot. This market needs to consolidate. So I don't think this is the FOMO moment where everybody should be rushing in. I think this is a moment to just cool off, digest the gains that we've had, and let the economy, which is a lot stronger than people expect, continue to chug along as inflation continues to come down and the Fed hangs its hat up.
All right, so Jim's really focused on Nick Timiraos from the Wall Street Journal. By the way, friend of the show, of my show, Worldwide Exchange. I think a lot of other people are looking at 12 straight months of declines when it comes to headlines, CPI. Liz Young, how do you feel about the second half?
Well, look, the CPI print today was definitely a good thing, moving obviously in the right direction, and now we're sort of rolling off the high print of last June. So we've got that in the rearview mirror. I don't think that a hike in July is absolutely guaranteed. The market still thinks that we've got almost a 90% probability of that. I think there's a decent probability that they might be done, or that they might prolong the pause even further, because there has been good progress. And it's okay to be positive about that progress. Now, to Jim's point, are new lows in our future? I don't know the answer to that. Obviously, I think it would require some sort of confirmation that we are actually going to have a recession, or that there is going to be a contraction in the economy. And there continues to be data that conflicts that. So it's gotten ever muddier, and it continues to be muddy for those of us who are still expecting that an economic cycle does end in a recession. And as we are still in late cycle behavior, it's difficult for me to believe that we won't see one. But until we have confirmation of that, Jim's probably right. We're pretty far from those lows. We're far from October. And I think there's probably still room for a continued rally if we don't have bad news. But I do not see a lot of upside over the long term from these valuation levels.